So as we know, discounting our free cash flows as well as our terminal value back to the present value will give us an enterprise value. But then to build down to getting a price per common share, we need to first find what equity value is. Because once we have equity value, we can divide the number of shares outstanding to get to a price per share. So in this slide, I want to walk through how we bridge from enterprise value to equity value. And that is by subtracting out net debt. Now, when I say net debt, what I really mean by this is total debt minus cash and cash equivalents. So I think a nice illustration we have here is this is a purely illustrative build from enterprise value down to equity value. But what we can see here is that our total debt is 1,000. Also, in total debt will include things like non-controlling interest, preferred stock is another tranche that would be included here. But we're assuming a relatively simple capital structure. So we have total debt. You'd also subtract out non-controlling interest and then add back cash. Because as we know, net debt is total debt minus cash and cash equivalents. So here you're doing a double negative. You're adding back cash to equity value. So in this case, since we have more debt than cash, our equity value is going to be less than our enterprise value. But I have seen cases where equity value is actually higher than enterprise value if the company has very little or no debt, but a large cash balance. So that's something to keep in mind. This is purely an illustrative build, but this is the first step we have in building from enterprise value to equity value. That's subtracting out net debt. And by net debt, I mean subtracting total debt and then adding back cash to get to equity value.